Michael Saylor announced an absolutely massive Bitcoin buy this morning. Over 34,000 coins added, that brings their total treasury to over 815,000 Bitcoin. Last week they bought $1 billion worth, this week they bought 2. The machine is accelerating, and they paid for it primarily raising billions through Stretch, or STRC, which, depending on who you ask, is either the most important piece of financial engineering since the iPhone or the next Terra Luna, waiting to collapse and take Bitcoin's price down with it. YouTube investigator Coffeezilla just dropped a video calling it a perpetual motion machine. Saylor's calling it the simplest financial product ever created. So who's right? Today we walk through what STRC actually is, what Coffeezilla got right, what he got wrong, and the bigger question no one seems to be asking. Has Saylor quietly stopped trying to fix the money? This is Truth Block. I'm Hurley. Let's mine truth. Whatever your thoughts are on Michael Saylor, you can't deny this strategy is working, at least for now. A staggering $3 billion worth of Bitcoin bought in the last 2 weeks. During a bear market, mind you. And it's clear Saylor doesn't care whether the Strait of Hormuz is open or closed. He always be stacking. And while Strategy's Bitcoin holdings continue to go absolutely vertical, the internet is still very much divided on whether his company and the product funding these buys is about to blow up or not. On one side, we have Bitcoiners pointing at the growing fortress of a balance sheet, over $60 billion of Bitcoin and counting. On the other side, we now have Coffeezilla. If you don't know him, he runs one of the biggest investigative YouTube channels on the internet. He built his whole brand exposing scams, FTX, Logan Paul's crypto grift, celebrity token pump and dumps. The man's done some great work. A few days ago, he turned that same lens on strategy and walked through STRC structurally. In his video, he called it a financial perpetual motion machine and compared it to Terra Luna. Many Bitcoiners dismissed him. The same guy who calls everything a scam clearly doesn't get it. And look, on some of that, the pushback is fair. But I'd argue Coffeezilla actually landed some punches. So today I want to steelman both sides. Saylor's defense first, then Coffeezilla's strongest critique. Then the bigger question neither of them is really asking. What does STRC actually represent? And has Saylor's mission quietly changed? Let's start with Coffeezilla's central framing. He's not calling it a Ponzi outright. He's saying it has the shape of every too-good-to-be-true yield product that's ever blown up.
There's always a question with all of this financial engineering. Anytime you see it, you always wonder, what is the catch? And I like to describe it like a perpetual motion machine. You may have seen, these videos of people, they invent a system that can come up with free energy. And there's always, some weird base plate that's made out of wood or something that they won't let you inspect. And that's because there's always a battery hidden somewhere in the device, because no matter how many times people say they've cheated thermodynamics, actually they've just cheated you. They've hidden the actual system somewhere, and you don't really fully understand that when you're getting in. And that's really how I feel about all too good to be true yields in finance. There's always a battery hiding somewhere or a risk that you're not really aware you're taking on. Like if you think back to the Terra Luna collapse, there was a stable coin, an algorithmic stable coin involved, which was supposedly pegged to $1 until it suddenly wasn't, and then everyone lost their money suddenly in a crash. But before that, it had yielded about 20% returns. People thought it couldn't fail. And so it goes for many of the most famous financial engineering projects throughout time. It's only obvious where the risk was in hindsight for a lot of people. But I'm making this video to tell you it's also obvious in foresight if you know where to look. And you just know that super high yields always carry a lot of risk. The only question is, where does that risk exist?
That's a fair question to ask. Where's the battery? We should always ask that when we see double-digit yields. That's just good financial hygiene. And he's right that Terra Luna fried a lot of brains. 20% yields right up until there were none. Healthy skepticism is warranted here. Where we part ways is on whether the foundation underneath STRC is the same as Terra Luna's foundation. Terra's foundation was an algorithmic stablecoin, a piece of code pegged to the dollar with nothing real backing it, just math and a prayer. STRC's foundation is over $60 billion of Bitcoin sitting on Strategy's balance sheet. Those aren't the same thing. And I suspect Coffeezilla knows this. He just doesn't weigh it the way we do. And we'll get to why I think that is a bit later. First, let's hear how Saylor himself handles the Ponzi accusation when it was put to him directly last year on CNBC.
So what do you say to people who say, well, it's a Ponzi scheme because every time Bitcoin goes up, you issue more equity and debt to buy more Bitcoin. It just keeps going and going and going.
Yeah, just like developers in Manhattan, every time Manhattan real estate goes up in value, they issue more debt to develop more real estate. That's why your buildings are so tall in New York City. It's been going on for 350 years. I would call it an economy.
That's the cleanest defense of his model you'll hear. Issuing equity to buy productive assets isn't financial engineering, it's the way capitalism works. What makes strategy different isn't the mechanism, it's the asset underneath. STRC is over-collateralized by Bitcoin roughly 5-1. Every dividend payment they've announced has been honored. The structure is publicly disclosed. This isn't Terra Luna. It isn't FTX. It's a publicly traded preferred stock with a transparent balance sheet. So when Coffeezilla asks where's the battery, there's an answer. The energy isn't coming from nothing, it's coming from Bitcoin appreciating against debasing fiat. That's the battery. And it's not hidden. It's literally on the homepage. But Coffeezilla did actually land some punches that we should be honest about. For one, the way strategy is marketing this thing doesn't always match the way it's built. It starts with an ad you may have already seen.
Are you on vacation here?
I live here. I'm retired. I just don't think I'm meant to live an uncomfortable life.
Wow, how did you make it?
I worked hard as an engineer to save money. Again. Then I put my savings into Stretch.
What is Stretch?
Stretch is a stock. Right now I get about 11% a year in dividends. Nice.
It's the Stretch, yeah, the Stretch. 11% monthly cash dividends, tax deferred.
Okay, that happened. An AI-generated woman on a beach claiming she retired by putting her savings into Stretch. I'll agree with Coffeezilla here, the ad is cringy. Strategy's marketing department clearly has work to do. It looks scammy, not because it is a scam, but because it mimics the visual language of every actual scam you've ever scrolled past on Instagram. When the product is this serious, the marketing should match. And that leads directly to Coffeezilla's strongest point.
So again, you can see why this is compelling to people, right? They're presenting it like such a simple thing. It's just like your savings account, right? But better, but just juiced returns. Now, what is the problem with that? Well, ultimately, Stretch is nothing like a savings account. It is a stock, meaning the company has no obligation to pay you that money back. Like you give them $100, they have no obligation to pay you back. And you actually find this in sort of the longer podcasts where Michael Saylor gets kind of asked about some of the risks of this strategy. And he uses the double speak of how they talk about this stuff to, on the one hand, make it seem like, oh, well, strategy really has no obligation to pay these people, so there's not much risk of a bankruptcy if they can't pay these obligations, while at the same time making it seem like they're definitely going to pay you the money.
When you put $100 in a savings account, the bank obviously legally owes you that $100 back on demand. When you put $100 into a money market, you can redeem at par. When you put $100 into STRC, Strategy owes you one thing, a variable monthly dividend, which they can legally suspend if paying it would make them insolvent. And that's it. To get your money back, you have to sell your share to another buyer on the open market. If demand dries up and the price drops to 90 is what you get. Now, to be fair to Strategy, they're engineering the price to stay around $100, and it's working. STRC has barely moved from $100 since launch. So in practice, retail investors have been able to get out at par. STRC is a genuinely new structure, so the analogies are imperfect by necessity, but the side effect is retail walks in thinking they've got principal protection that they don't actually have. Coffeezilla's right to flag it, and we can say that without saying the product is a scam. Both things can be true. But here's the deeper thing nobody's saying, and I think it's the most interesting part of the whole story. 5 years ago, Michael Saylor came out swinging. There was no second best money, fix the money, fix the world, Bitcoin is hope. This wasn't a marketing line back then. It was a philosophical argument. Hard money restores truth to the price system. Separate money from state. Fix the broken incentive layer that flows downstream from fiat debasement. It was a sovereignty argument. Now listen to how he frames the mission today from his recent conversation on Bankless.
So how do we fix the money for 1 billion people? And what we realized is the answer is not convincing 1 billion people to adopt Bitcoin as the currency instead of the dollar or the yen or the euro. And the answer is not getting them to, throw away their bank, replace the government, rethink their world, disclaim interest in all corporations, and self-custody, right? These are all crypto ethos things. And it's not that I'm not negative on them. They're all valuable. But I think after 5 years, And believe me, I preach Bitcoin to more people than, anybody, It's 1,000 hours, and you're going to convince 1, 2, 3% of the people to put 5% of their money into this asset. You're not going to convince 75-year-old retirees, right? Nor should you. So what's the great product idea? Wouldn't it be great if I just bought a product and it paid me money for the rest of my life? Like, I just want 10%, a bank account that pays me 10% or 8%.
Did you catch that shift? The mission used to be teach 1 billion people to hold the hardest money ever created. Take it out of the system. Custody it yourself. Now the mission is deliver Bitcoin's yield to 1 billion people who will never hold Bitcoin directly. A product that sits inside the system and pays fiat dividends that you buy through your brokerage. You don't custody it, you can't take it with you. And the framing tells you everything. Earlier in that clip, he talks about Rockefeller and kerosene, Ford and the automobile, Jobs and the iPhone. That's the industrialist playbook. That's not the language of a monetary reformer. That's the language of a guy building a product. He even names it explicitly. He says the answer is not convincing people to adopt Bitcoin, not getting them to self-custody. Those things, in his words, are crypto ethos things. That used to be the whole point. And here's the kicker. What Saylor is describing isn't disintermediation. It's reintermediation, with Bitcoin as the underlying reserve. If you're holding STRC, you're not in the Bitcoin system. You're in the Saylor system, which just happens to be backed by Bitcoin. That's closer to a gold-backed bank than the cypherpunk vision Bitcoin was built around. Bitcoin was designed specifically to make this kind of trusted intermediary unnecessary. Saylor's building one anyway, just with harder collateral underneath it than anyone has ever used. Now, none of this means Saylor stopped believing in Bitcoin. He's clearly still buying it by the truckload. But the pitch has changed, and the pitch is what reaches the next million people. Maybe that's a legitimate on-ramp, and the base layer gets stronger because of it. Or maybe that's not a revolution at all, just a better-looking version of the old system with harder money underneath. Fix the money used to be the conclusion of a philosophical argument. Now it's the tagline on a product pitch. That's not nothing. And the financialization is just getting started. Wait till you see what the DeFi crowd is doing with Stretch. A startup called Saturn just launched a tokenized version of STRC. They call it SUSDAT. Their pitch is to take Saylor's 11.5% yield and bring it to anyone in the world through DeFi. Once it's on chain, you can lever it up 4, 5, 6 times through protocols like Morpho and Aave. They're building structured products on top. They're calling Stretch the risk-free rate on chain. And their projection for Stretch's market cap over the next decade is between $500 billion and $1 trillion. And Strategy's not slowing down either. This past Friday, they announced they're moving STRC to semi-monthly dividends. They're iterating in public and fast, optimizing the product to pull in even more fixed income capital, which is where you have to step back, because we need to remember that Bitcoin is Granite. That's the foundation Saylor has dug into, and he's dug in deep. But the layers being built on top of the Granite, the leverage, the tokenization, the perps, the DeFi yield farming, those aren't Granite. Those are derivatives. And history tells us that derivative stacks get spicy. The same DeFi crowd that gave us Terra Luna, Celsius, FTX, and 3 Arrows, they're now building on top of Stretch. They're going to amplify it. They're going to recursive loop it. They're going to do what they always do. Some of it will fail, and people will likely lose money. And because all of this ultimately traces back to Strategy's Bitcoin treasury, we should at least name the Cascade risk honestly. So what is the bear case? I would say a deep and sustained Bitcoin bear market. STRC demand dries up, Strategy gets forced to sell Bitcoin to honor dividends. Forced selling pushes the price lower, the leverage stack unwinds. That's the scenario Coffeezilla is gesturing at without quite saying it. Is it possible? Sure. But Strategy has 2 years of dividend coverage sitting in cash and 47 years of coverage in Bitcoin at current market prices. The buffer is enormous. And even in the worst case, the Bitcoin protocol doesn't change. The 21 million cap doesn't change. Self-custodied Bitcoin doesn't get touched. Mt. Gox, Celsius, FTX, 3 Arrows, each one was supposed to kill Bitcoin, and none of them did. The Granite held. Which brings us back to Coffeezilla, because there's a part of his framework that explains why he can't see what's actually happening. Look at the comparison he keeps reaching for. STRC to Terra Luna. As if Bitcoin backing Strategy's balance sheet is interchangeable with the lines of code that backed Terra. He's conflating Bitcoin with crypto. Same mistake every mainstream critic makes. If Bitcoin is one more speculative asset that could go to zero, then yeah, STRC is a Ponzi on top of a Ponzi. But if you've done your 100 hours, the math flips. It's financial engineering stacked on the hardest money in human history. And that's the twist. Coffeezilla himself, at the end of his own video, stumbles right into the answer.
You can pretty quickly realize that, hey, this is maybe not as sustainable as they're claiming it is. That is, of course, unless you believe in what Michael Saylor does. I mean, he says his expected return on Bitcoin is 30% a year.
We think Bitcoin's going up about 30% a year. So can I pay a dividend of 10%, 11%? Yeah, sure I can. That's like 1/3 of my expected ARR.
If you believe what Michael Saylor just said, one, you should just be investing in Bitcoin directly. But yeah, they can pay that dividend in perpetuity, of course. If anything goes up 30% a year, they can pay 11% of that to pay some kind of, money market-like account. But that is not where most people are. It's definitely not where most of retail investors are. They aren't in a position where they can make those kind of bets.
There it is. He didn't mean it as a Bitcoin endorsement, but it is one. And if you're watching this channel, you've likely already done the work. You already hold your own keys. You don't need STRC. You never did. The audience STRC is actually trying to reach is the audience that was never going to self-custody anyway. Coffeezilla just stumbled into telling them the simple answer on the way through. Accidentally correct, which, credit where credit's due, is still correct. But there's one more piece. The day after his STRC video, Coffeezilla posted another one, and it accidentally explains why he can't see what's actually happening.
What are you doing? What are you thinking? I just want to grab some of you and go, why would you invest in this? What is the big idea? When you have the stock market go up for long enough, for a while, we just hit new all-time highs after a dip in Iran. We have this like two-tier economy that's really just like a lot of people feeling like it's a recession. Most people getting crushed by inflation, getting crushed by stagnant wages. And then on the other hand, you have the stock market, which just seems to rip no matter what, basically. And I think this has led to an air of complacency. I mean, you have a famous quote from Warren Buffett that you only find out who's swimming naked when the tide goes out. The idea is that when you have a bull market for long enough, when things are going well in the stock market for long enough, investors just lose their discipline. They lose an ability to see just like basic, obvious, stupid investments.
So he sees how broken this economy truly is. But what he doesn't see is why. The gambling culture, the hype cycles, the recursive financial engineering, the shoe companies pivoting to AI, these aren't separate phenomena. They're all symptoms of the same thing. The money is broken. And when the money is broken, you get a broken economy downstream. You get desperate reaching for yield. You get casinos disguised as markets. Coffeezilla sees every one of these symptoms clearly, better than most journalists do. That's the irony. He sees the disease, he just can't see the cause and the cure. Here's what he's missing. STRC isn't a symptom of the broken fiat economy. It's Saylor using the tools of the broken fiat economy to quietly funnel capital into the one asset that fixes the broken money. That's the whole trick. Every dollar that goes into Stretch pulls a dollar out of the fiat casino and locks it behind Bitcoin's balance sheet. Coffeezilla's standing inside the casino, pointing at all the slot machines going, "Isn't this insane?" And he's right. And he's watching a man at the back of the room quietly rewiring the whole building so that every coin pulled from every slot ends up on a hard money foundation. And he can't see that part because he hasn't done his 100 hours on Bitcoin and because he hasn't seen that the money itself is what's broken. That's not a knock. That's just a framework. The framework decides what you can and can't see. So let's pull the threads together. Coffeezilla got the marketing right. The AI ad is bad. The bank account analogies are overreach. Retail shouldn't be the target audience for an untested preferred stock tied to Bitcoin's volatility. That's a fair critique. But the foundation is Granite. STRC isn't Terra Luna. The collateral is real. The dividends are being paid. Mechanically, it's working. Coffeezilla missed it because he's still seeing Bitcoin as one more speculative asset in a casino full of them. Which leaves the deeper question. Did we want financialization on top of Bitcoin? Honestly, probably not. The original ethos was to escape the fiat system, not build a better looking version of it inside the system. But let's be real. Financialization was always going to happen. The minute you build the hardest money in history, every fiat institution on earth wants a piece of it. Saylor's just first. The DeFi crowd is right behind him, and Wall Street wants a piece. We don't stop it. We ride it out. We hold our keys. We watch the leverage stacks build, knowing some of them will collapse. We don't bet against Bitcoin. We don't bet on leverage layers either. We stay humble and solvent, and we continue to stack the monetary revolution into cold storage. Because Bitcoin is granite. The things on top might tumble. That's fine. Let the gamblers gamble. We own the foundation. So Saylor's pitch has changed. Maybe that's strategic. Maybe he's right that the next billion people won't do the 100 hours of research to understand Bitcoin. Or maybe the work of fixing the money still belongs to the people holding their own keys. In the end, fiat games will keep being played. STRC is one of them. Stretch on DeFi will be another. And there will be more. But none of those are the revolution. Bitcoin is the revolution. And the revolution is quiet. It's peaceful. It's bottom up. One person at a time, one wallet at a time, one set of keys at a time. That's the whole thing. So build your house on granite, not on sand. All right, that's all I've got. But before we close, I want to hear from you. Do you think Saylor's message has actually shifted? Or is this just a smarter path to bring Bitcoin to the masses? And what worries you more, STRC itself or the DeFi yield farming crowd building leverage on top of it? Let me know in the comments below. And I just want to say thank you to the warm welcome I received in the comments on my first video with Simply. It means a lot, and I'm super stoked to be bringing you more content every week. If you got something out of this one, don't forget to smash the like button and share it with someone who thinks strategy is a Ponzi. And don't forget to subscribe to Simply Bitcoin if you haven't already so you don't miss the next truth bomb. I'll see you on Thursday.